Very excited to be here. Thanks for including me on the program. My name is Chuck. I'm from Drexel. Excited to talk to you about liquidity misallocation on decentralized exchanges. Here's a clicker. So there was like a long period of crypto winter, and I think many people, including me, thought, like, is crypto gonna die? DeFi gonna die? Gladly, not the case. This year, crypto and DeFi is making a return, like literally and figuratively, right? So they are making a return, and the return they generate for investors are humongous. So Bitcoin has had like over 150% return over the past 6 or 7 months, just dwarfing what the return on S&P 500 is. Similarly, DeFi is making a return. So this is trading volume on decentralized exchanges. Different colors represent different dexes. The biggest one, I think, is Uniswap. You see that there's, over the past several months, trading activities has gone back. There's more trading on these decentralized exchanges. And this paper tries to understand these decentralized DeFi a little more. So, these decentralized exchanges, what do? They provide liquidity, a very primitive form of liquidity to quickly convert one asset to another, right? So I have a hospital bill. I need to liquidate my Bitcoin holdings to pay for the hospital bill. I do that quickly, and I want to get as much money back as possible. So that's a liquidity I'm going to talk about in this paper. And decentralized exchanges aim to provide liquidity without centralized intermediaries, right? So I'll get a little bit more into what that means specifically, but I just want to reiterate something I already said. They have been very successful. The trading volume on these decentralized exchanges has gone up tremendously. If you look at a longer time horizon, in 2020 when they first started, there were 86 billions of trading volume in that year. Last year, they had close to $1 trillion trading volume. What's interesting about these decentralized exchanges is that most of them are organized as AMMs, not the traditional limit order book. And the question I'm going to delve more into is, who provide liquidity on decentralized exchanges, and do they do it efficiently or not? And here are the findings. What I find is there's significant misallocation of liquidity across dexes, specifically the liquidity pools on Uniswap. So it's not very efficient, the liquidity allocation. What does that mean? What I mean by misallocation? Well, some pools have very high risk-adjusted returns, and some pools have very bad risk-adjusted returns at the same time, right? And that is sort of the definition of misallocation in financial markets, right? If whoever is providing the capital is really chasing the right return, then you should equalize return in equilibrium. And why is that? Why is that the case? Well, what I show is that liquidity providers do not behave optimally to compete away these liquidity returns. Instead, they focus on one part of the return that is saliently marketed, and they sort of ignore the other part. And there's some interesting sort of correlation between the two returns, and in net, they do not compete away the net returns. Some numbers to take away. So the average LPs could have made 6% more on an annualized basis if they do this optimally. So, I feel like 6% in crypto world is not huge, but I think it's huge. And if you compare it to traditional market. All right, let me briefly talk about my contributions to literature. So there's growing literature on AMMs, but seems like most of the literature has assumed perfectly rational optimizing LPs. And what I bring to the table is to just show that the average liquidity provider is not that sophisticated. They make mistakes. They're subject to these behavioral biases. Also, my paper speaks to sort of how behavioral biases will affect the market. So, there could be behavioral biases, but if they're small, they don't matter, right? So what I show is they actually have consequences on equilibrium market returns. And lastly, I speak to both the bright side and the dark side of DeFi. We have these awesome financial innovation, and what I show is there's some misallocation that can make the whole thing better. Okay, so some background. This is sort of just repeating what the previous 4 papers have talked about over and over again. So I'll be quick. Take a step back. What is decentralized exchanges? How is it different from centralized exchanges? Well, it's easy to motivate that if you look at FTX. So FTX is centralized exchanges. What's wrong with it? Well, it can take your money. So this is what happened with Sam Bankman-Fried, right? So it's a centralized entity that writes the ledger, and this way it's not very secure. Most of them are organized as limit order books, and in limit order books, the typical way liquidity is provided is through these very sophisticated players, think about like Citadel. These high-frequency traders, they provide bid and ask, and they constantly adjust bids and asks. What are decentralized exchanges? Well, they're like Uniswap. These are based entirely on the blockchain. There's no centralized intermediaries. There's no SBF that can take your money away. It's on the blockchain. And there are some other benefits, right? It's trustless. It's 24/7. They're very hardworking. There's no break for them, and there's anonymity for these for decentralized exchanges or blockchain in general, right? What's at least initially, what's the motivation for AMM was if you wanted to limit order book, updating your price at a high frequency was just not feasible, right? So you're an LP, you provide liquidities. If you want to adjust your price, well, each time you make a transaction on chain, there's a high cost, both in terms of money and time. So it was not possible. We're going to do this again. Okay, we got it. All right, that's very reassuring. Let's continue our discussion of AMMs. So anyway, so limit order book was initially not very feasible on blockchain. So we resorted to AMM. It turns out to be very successful. So how does it work? People have shown this. There's a curve, and then you can trade one's asset versus the other following this, for example, this constant product rule. Why does it work? I want to just address that very briefly. They satisfy some very basic properties, right? So suppose that you triple the amount of Bitcoin you swap in. So you swap in not just delta X amount, you swap in like triple the delta X amount. You don't get triple the the other asset back, right? So the more you swap, the more liquidity you use, the higher price you pay, right? And then we can write down price analytically, and you realize it's just a ratio of the 2 tokens in the pool, which is nice because this basically tells you sort of the relative scarcity of the token you're trading. So the more scarce something is, the higher the price of thing is. And this price adjusts according to order flow. I think that's an important property, right? So the more you trade something, price adjusts. The more you buy something, the higher price that thing is. So that's why AMM sort of works. Let me focus more on liquidity provision, which is what this paper is about. So liquidity providers deposit and withdraw both assets. They don't just do one asset versus the other, right? So in this case, K is the invariant for traders. In this case, K changed and P doesn't change, right? And so that's how liquidity provision works. And liquidity provision is very easy, right? Compared to the bid-ask model, the limit order book model, you just say how much I want to supply liquidity. You just specify the quantity, and you let the AMM adjust the price. Okay, so it's very easy. What's in it for liquidity providers? Why would they do this? Well, they earn fees as a fixed percentage of each trade. So there are rewards. One thing to note is that this fee is shared by all the LPs in this pool. So there's like a natural decreasing returns to scale, right? If there are more LPs in this pool, we share the same profit from these traders. The more LPs there are, the less returns we get. Okay. Lastly, this liquidity provision has cost too. So this is what Agostino was elaborating on. They incur these impermanent losses during price adjustment, right? So we like price adjustment, right? We don't want to provide liquidity as a constant price. And how is the price adjusted? These functions help us adjust it. But it's not free, right? It's not perfect. Whenever price adjusts, the liquidity providers lose during the price adjustment process. So let me give you an example. So suppose the Bitcoin, the market price of Bitcoin goes up. The price in the pool still doesn't change because it requires trading to change. So some people will buy from this pool at the old stale pool price, and you lose, right, as a liquidity providers, because you should be selling at the higher price, which is reflected in the market. So that's in a nutshell impermanent losses. You have to sell at the stale low pool price. Here's a function. You can plot out what the impermanent loss exactly is. It's an analytical solution. You see that if the price, so the new price P primes divided by P, if this price doesn't change, say as 1, you don't have any loss. But as long as the price decrease or increase, you lose. Okay? So let me just summarize briefly what is different about AMM versus the limit order book that we're familiar with. What's not different is you still need liquidity providers. What is different this time is you only specify quantity, not price. Very easy. You just say how much liquidity I want to provide. You don't specify like I need to sell at this price or buy at this price. Not different. Liquidity providers are compensated. Not a big surprise. Instead of being compensated on the bid-ask spread, you are compensated based on the fee revenue, which is just a fixed percentage of the trades. Not different, price adjusts according to order flow. In this case, this is deterministic. Okay, this adjustment is pinned down by the function. You know exactly price change is going to be given order flow. Okay, so the data that I will use will focus on Uniswap v2. Let me jump into the first results of the paper. So think about what is the efficient market and how do LP returns look like. I'll argue that in an efficient market, LPs should earn 0 adjusted returns on net, right? So remember, the liquidity provider's return has 2 parts. They earn fee revenues, and they incur these impermanent losses, okay? What they should care about is the net, right? And I'll argue that this net return should be 0 in equilibrium. Why is that? Let's suppose that the return is very high. Then what would liquidity providers do? Well, you should put more money into that thing, right? As soon as you put more money into that thing, the pool grows, but the fee amount is fixed. But suppose if the trading amount in that pool is constant, then naturally your fee revenue as a percentage gets diluted and your returns goes down, right? So there's a natural equilibrating forces here. Empirically, however, I find persistent risk-adjusted net return differences across pools. Okay, how do I do that? How do I find that? Well, I'm going to use a sorted portfolio approach. It's a pretty simple finance tool, which is just, let's look at all of the pools. Let's sort them into by the net returns they had over the last period. let's see what is the net returns over the next period. Okay, so pretty simple exercise, and here are the results. So I'm sorting the pools from low past net returns to high past net returns. Okay, the middle column is what I want you to focus on first. So this column shows you the next period net returns. Okay, we sorted on the past, and we look at the next period. What this shows is that pools that have bad net returns in the last period continues to have bad net returns. Same with vice versa with the high return pools. If you have high net returns in the last period, you will have a very high net returns this period. The difference between the low past return pool and the high past return pool is at 64 basis point, 0.64 percentage point per week. If you annualize that, that is around 39 percentage point per annum. Okay. So you can actually decompose this net return into the two parts, the fee revenue and the impermanent loss. What you see is that the bad net return pools, their fee returns are actually pretty high. So the 54 basis point there. But what's really driving the result is that they have terrible impermanent loss. They have high fee returns, but they just have very bad net return, very bad impermanent losses. So the net return is very bad. In finance, we care about some risk adjustment because this could be the high returns could be some loadings on the risk factors, so I can account for that, and that is not explaining the results, and I can show that transaction costs are not explaining the results. Okay, so I want to show you quickly one thing. So that was like a simple portfolio sorting approach. You can also use this option pricing approach because I just showed you that impermanent loss is deterministic with respect to price. So you can option price it. So what you can do is you can use a basket of options to replicate the payoffs of impermanent loss and see what the revenue you get from shorting those options. And here are the results. So the black line shows you the options implied returns that liquidity providers should get. The red line shows you the realized fee revenue from, this is the the Ethereum USD pool. There's only a few pools where I can get the implied volatilities to calculate these option prices. What you see is that there's persistent deviation between the two. Okay. In other words, you could have made a lot more money from investing in this pool, being a liquidity providers, and then you can hedge out the entire exposure through options. And the gap is what you're making without the risk. Similar stuff with Bitcoin USD pool. Okay, so the last part of my paper, I want to discuss the following. Why do abnormal liquidity returns persist? I said at the beginning, right? So in theory, if you're liquidity providers, you should respond to these net return differences, and then you compete away any liquidity return differences across pools, right? Empirically, however, I find these LPs are insensitive to net returns. Instead, they're very sensitive to the fee returns and insensitive to impermanent loss. And by the way, you could have thought like what I showed before is an arbitrage opportunity. I think in reality, there's a lot of frictions to really arbitrage on that 39% returns that I just showed you, because there's no shorting of LP tokens, no active market to shorting LP tokens. So that's why I think these things can persist. Okay, so in the last part, I just want to show you that if I literally look at how liquidity providers choose the pools to deposit liquidity, so measured by this liquidity flow, what I find is that they are insensitive to past net returns. So the coefficient, if I regress the liquidity flows on net returns, is not significant. If I partition this net return into the two parts, you see that they're very responsive to fee revenue and insensitive to impermanent loss. And one counter argument you can give is maybe fee revenue is the part you should chase because it's more informative, because it's more persistent. Well, you can do the exact same exercise I had, sorting the portfolios on just the fee revenues. And what you find is that you don't get any returns. Right? So chasing fee revenue is not a good strategy. And if you additionally sort on implied impermanent losses, so by the implied volatilities, you do see that this is very important to creating LP returns. Lastly, I just want to show that if liquidity providers were sophisticated, if they actually were equally sensitive to fee revenues as to impermanent loss, you can calculate some like counterfactual liquidity flows. If I just do that simple counterfactual analysis, you find that the liquidity returns, this cross-sectional liquidity return differentials shrinks by half. Just showing you that it is indeed related to misallocation. Okay, so for the interest of time, let me skip over how these returns and liquidity flow behavior changes over time, and just conclude that I think AMM is an important financial innovation. Many theories are being developed for them, but they often assume perfectly rational and optimizing behavior. What I bring to the table is just emphasizing that most of these liquidity providers don't seem to be fully optimizing, and they make mistakes, and these mistakes show up in the financial markets as prices, as abnormal returns. Thank you very much.
I think I will take exactly one question as well, and then we'll continue. It seems like it was chosen. Sorry.
First hand I saw.
It do be that way, sorry.
All right, yeah.
Go for it.
So I have two quick comments. The first one is that you don't know how exactly LPs are hedging, so it might make sense to consider lever instead of impermanent loss, because lever is the component that they cannot hedge, essentially. And my second, all right, so, and my second comment is you seem to be ignoring the utility function of many of these guys, because many of them are launching their own token. And so if I launch Alex token, you launch Chuck token.
Yeah.
Your token is not going anywhere, you're earning fees, but no impermanent loss. My token is growing. and I have a huge impermanent loss. And I lose money. Impermanent loss is bad, but I generate
We're fine
fees.
with it.
But I shouldn't be. You tell me that I should be LPing in your pool instead? No, thank you. Right. So I guess there is a component to the utility function that is missing from the traditional sort of finance.
You're basically saying the liquidity providers are not necessarily not caring about the returns, right? Yeah.
Many of them maybe not doing that. Yes.
Oh, thank you again. Pause for the speaker.